Retirement investors in shock after Fed's big bark, no bite talk, which causes the stock market to reverse to the downside. We're going to take a look and see if this slump continues, so stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. We have some good information to share with you here today, but first we're going to dig deep into why the markets reversed to the downside after Fed Chairman's tough talk speech. We're going to look at what we can expect here for September, and also we're going to look at some good news here. Once this downtrend's over, what can we expect? So I want to thank you for watching here. Now on this channel, we not only talk about investing for retirement, when to retire, how much to save for retirement, but we also investigate Social Security. So stay tuned for our full episode. As we said in a previous video, Powell warned of pain to bring down inflation, and pain we did get. Here's a weekly chart of the S&P 500 ETF Index SPY, and you can see we reversed to the downside. We're down about 17% for the S&P 500. We had a very nice move to the upside. It looked very promising, but once Powell gave his speech, the markets reversed. We're looking at the Nasdaq 100 QQQ. Again, down nearly 30% for the year after this current reversal to the downside. Here's why the stock market reacted so violently to the downside. In the early 80s, a lengthy period of very restrictive monetary policy was ultimately needed to stem the high inflation and start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year, Powell said. Our aim is to avoid that outcome by acting with resolve now. Let's dig into a little history here on inflation and the Fed fund rates back in 1970 through 1978. The Fed chairman at that time was Arthur Burns. Inflation was starting to take off in 73, 74. They raised the federal fund rates. Then they started to lower the rates when they saw inflation dropping. The first mistake the Fed made here was they lowered the federal funds rates too low too quickly before inflation was put to bed. Inflation started to take off again, so they brought in a new Fed chairman from March of 78 to August of 79. Inflation rose from 9 to 13%, and they had to raise the federal fund rates again in the range of 10 to 12%. This is what Powell is wanting to avoid. He wants to take care of this, nip it in the bud the first time so they don't have to come back the second time and raise rates even higher. With the rates skyrocketing in 79, the hot seat was too much for William Miller, and they brought in the Fed chairman Paul Volcker from August of 79 to August of 1987. Volcker then proceeded in 1980 to raise rates as high as 18%. In 1981, inflation was starting to come down slowly. Rates were still high at 12% in 81. In 82, inflation was starting to come down. However, they did have to continue the rates as high as 15%. And then by July of 82, Fed Chairman Volcker said, I think I've got hold of this. The Fed began lowering Fed funds rates and the markets took off. The reason the stock market and investors are so fearful of Powell's speech because they can now see that interest rates are going to have to maintain high levels for a longer period of time to quench the high inflation. Now here's a chart we showed the other day. In 1981, Volcker got tough. However, the markets did react to the downside. Once they were able to get a hold of inflation and they said everything looks good, the markets took off to the upside. So this is good news for those investors that are worried about what's going on. There is light at the end of the tunnel. Let's take a look at how bull and bear markets over the last 90 years have resolved. We're going to take a look at the period of around 2000 when we had the dot-com bust. Lasted 2.5 years, down as much as 49%. And you can see this area in the red is where the market dropped. Once this downturn was over, markets began a march to the upside for the next 5 years, up 101%. But then again, around 2007, we had the financial crisis, lasted 1.4 years, down as much as 57%. But look what happened once it was over. The market went up 10.9 years for a total of 401%. Now, currently, we've been down for 8 months. We've been down as much as 24% in the S&P 500 and about 35% in the Nasdaq 100. Now, for some of these stocks that have taken some big hits to the downside, they may have already hit their lows. We're looking at Amazon right now. This is a weekly chart, goes back to 2020. And you can see the lows here in Amazon around 100. It's been as high as 190. So we may have hit the lows for some of these stocks like Amazon. Here's a stock for Netflix. Again, it hit the lows of around 150, was as high as 700. So it's very possible stocks like this in the technology sector that have taken some big declines to the downside may have hit their lows. Now here's the stock for JP Morgan. Now it's hovering right around the lows. Now, if there's more deterioration in the markets, it's very possible a stock like JP Morgan could go lower. We're just starting into September, and historically, September is one of the toughest months for the stock market. Here's a chart of the S&P 500 monthly seasonality. This is year 2 of the presidential cycle from 1926 to present. And if we look here for the month of September, historically, September is one of the toughest months for the S&P 500. Now, interesting enough, Powell's speech had a big bark but no bite. Interest rates did not go up. He's very concerned about inflation, but they made no changes. You would think they would raise the rates almost immediately, but they didn't. However, the markets did take his speech seriously, and they sold off to the downside. At the time of this video, let's look at some various outcomes. This is a weekly chart for the Nasdaq 100. We had the plunge lower after the speech by Powell. We came down to some various support levels. So we have support from where the Nasdaq ended at the time of this video down here to the lows of June. If we can hold these lows of June, that's going to be very positive. Now, I would expect the market to bounce around. We're going to get some CPI inflation data coming up soon. There could be some warnings from various companies about their potential profits. That could also affect the markets. And then at the end of September, we're going to get an increase in interest rates, and we'll be watching how the markets react to that news. We're looking at the S&P 500 on a weekly chart. Now, for most investors, dollar cost averaging is the best method of investing right now. It's possible if the markets dip lower, we could get a lump sum investing opportunity for those that have extra cash. Now, for the person that's been in the market for the last 10 years, this downtrend really shouldn't bother you. It's normal for the markets to dip lower. The only folks that might be concerned right now, if you got into the market in the last year or so, then of course, this downturn is eroding some of your profits. At this time, I don't see any reason to bail out on the markets, but each person has to make their own investing decisions whether they want to be an investor right now or be out of the market. The stock market and retirement investors took the information from Powell very seriously, and the markets plunged and sold off to the downside. Now, Powell says it's going to be watching the data as it comes out over the next few months to determine how much to raise the interest rate. So it could be touch and go here for the next few months. So I hope you found this information helpful. Stay tuned for our next episode.